Hello, everyone. Welcome to today's edition of our Seven Investing podcast. I'm Seven Investing founder and CEO Simon Erickson. I'm excited today to get a little bit outside of my comfort zone and talk about institutional analysis and some things we typically haven't talked a lot about at Seven Investing, including relative strength and technical analysis, and what is it that's on institutional investor radars. To talk more about these subjects, I'm really excited to welcome my friend Irusha Peiris to the show. Irusha is a portfolio manager at O'Neill Global Advisors, joining me from Los Angeles today. Hey, Irusha, it's so good to have you back on the podcast again.
Hey, Simon, it's great to be here. You know, I'm a big fan of you for a number of years, and thanks for inviting me.
Absolutely. And I'm cheering for your Raiders out there, even though they've moved out of LA and now they're in, or out of San Francisco, and now they're in Las Vegas.
Well, they were also in LA too, but Las Vegas is not that far away. So there are plenty of LA fans who like going. Well, just to very quickly digress, I just found out that the Chargers are building their facility like 2 blocks away from me. And so I don't know. They're not going to get a warm welcome here, that's for sure.
Wishing you the best, my friend. Well, we have a lot to chat about today. We're going to talk a lot about a bunch of things. We're going to talk about how institutional investors look at investing. We're going to talk about valuations, and we're going to talk about some sectors on your radar. But I've got to start with kind of the big topic that's hitting the headlines right now, which is Tesla. And, you know, we always talk a lot about fundamental analysis with Tesla. We talk about earnings, we talk about sales, but it's almost expensive on any metric that you look at. And yet still Tesla's stock price continues to go up. Irusha, I know that you are a CMT. You know a lot about technical analysis. And I really want to kind of just get your feel for what you think about is what's going on with Tesla and Tesla's stock price right now.
Well, it's pretty simple. Tesla has become the must-own stock. Not just with institutions, I think with just everyone, but it has just become the stock. Now, has it run up a lot? Yes. Could it take a break and come back in a lot? Yes. And I do own Tesla, and so I should say, you know, anything I say shouldn't be definitely taken as a buy or sell recommendation here. But that being said, it's taken a while, but Tesla in many ways, and I can talk about our kind of the framework that we use to analyze stocks too, but Tesla fits that framework, and really has really fit the framework for a number of years, in that we're looking for what companies could change the world. And really, there aren't many other companies out there that can change the world as much as Tesla. And because they had that huge goal that Elon Musk put out years ago, that he really wanted to try to help with climate change and try to get off of oil and get into electric cars and things like that. But it's not just the car, right? They've through the life cycle of the company over the last 10 plus years, they've come up with so many other innovations out there that it almost seems like it's converging at the same time. Like all of these innovations they've done and different verticals are all just starting to expand. And so it's become this must-own stock. It's become a stock that's essentially become impossible to value. And it is obviously, with the way it is moving now, it's clearly in demand and continues to be in demand.
Let's talk a little bit more about that framework, because it's definitely got the vision there. Nobody is going to say that Elon Musk is not a visionary leader, but there's a lot of visionary leaders out there. Seems like Tesla executes very, very well, whether that's number of vehicles delivered, number of orders they've got, just the progress they've got with new models. There's a bunch of things we can say about this. But we know that's all out there. Can you talk a little bit more about the framework that you tend to look for and why you would consider Tesla to be a must-have stock out there?
Yeah, so the framework was designed by William O'Neill. So Bill O'Neill, he's the founder of Investor Business Daily, originally the founder of the William O'Neill and Company, which was the institutional brand. And that was the first company he started 50 plus years ago. And then when he did really well in the markets during the 82 bull market, that really turned out to be like the next great super cycle. But that 82 run, he made enough money that he started Investor Business Daily with that money, and to help kind of normal people. So first he was helping the institutions with kind of, here's a framework how to look at growth stocks that are changing the world, because it's very hard using kind of traditional valuation type of frameworks to capture some of these new potential monster stocks. And then he learned all that stuff and shared it with us, normal people. And I was one of those customers. So that's really kind of the thing. So for people who want to learn it, but How to Make Money in Stocks was the book. I mean, I actually have the 4th edition here. I'll show it right here. But
Very
How to
nice.
Make Money in Stocks for those 10% who are watching the video. But it's by William J. O'Neill, How to Make Money in Stocks. But just very quickly, I'll tell you how I got into all of this, just the stock market. I was a bio major. I had no idea about stocks even after college. Doing medical research, thinking about becoming a doctor. But like everyone else, you just like, oh, maybe I should put some money in the stock market. Well, I started putting the money in the stock market around 98, 99. And obviously we know that was the whole dot-com boom, and all my stocks went up, and I thought I was a genius. But it was really 2000 when everything came down and all my stocks came down too, that I started to realize that, wait a minute, there's more to this. And so I learned immediately that it was the buy and hold, wasn't necessarily for me. And what appealed to the strategy that Bill O'Neill was talking about is he was talking about a framework first, looking for growth stocks. And I love technology and all that kind of stuff, so that appealed to me. But also risk management. You kind of have some kind of exit strategy when you know you're wrong. And that I never heard anyone talk about in the stock market before. It was like, stocks are going down, you buy more, and there are a lot of stocks you'll get away with if you're picking good, but there could be some that you keep buying down and just keeps going down, and where it could destroy your portfolio too. So that kind of strategy of having an exit strategy appealed to me. Now the framework really appealed because I never heard about someone talk about look for newer companies that are changing the world, they're bringing in technology that it's hard for people to imagine. So really some of the things that he looks for in the framework, and really what we teach, we teach in Investment Business Daily, what we also go over on the institutional side at William O'Neill and Company. We're looking for, companies that are having just these huge earnings and sales. So on a quarter to quarter basis, or year over year, but just on a quarterly perspective, there are some companies that are going to have like triple digits. Their EPS are 100% higher than they were the year before. Their sales are like 70, 80%, and it's pretty consistent. You're just seeing these monster numbers come after over year, quarter over quarter, and then eventually over 3 to 5 years, they're pretty consistent at putting these monster numbers. Those are numbers that very few companies can do, right? And so they must be doing something special. Either they have a product that's out there that's so in demand, or a service, and they're just selling out. And a lot of times what's happening is they're creating a new market, a new category. And everyone's thinking, oh my God, this is the greatest thing. Apple 15 plus years ago is a perfect example. They came out with the iPod. I remember when I saw that thing, I was like, who would be dumb enough to buy a $400 music player when I got my Archos jukebox music player for $100, right? But what I didn't realize is that they were making it a lot easier to upload music and maintain it, especially once it moved to the PC. And then, of course, they took that money. So Apple at that time, triple-digit earnings, triple-digit sales, just going crazy. Margins were through the roof. They obviously they took that and turned it into iPhone, the iPad, and all these other things. But same thing with the Tesla, right? So now they're starting to put all these huge earnings and sales. And where Tesla really initially came up on the radar for me was back in 2013. Sometimes you'll discover you're not even by seeing the numbers. I saw the car. I still remember I was in Santa Monica on the promenade, and they had a showroom there, and I saw the Model S for the first time. And it was a $90,000 electric car. And I was like, this is the most amazing car I've ever seen in my life. And they were selling out of a $90,000 car. And so I started thinking, if this guy pulls it off, he could change the world by convincing people to buy a $90,000 electric car. Right. So that was kind of the first place where it really started to kind of, trigger in my head that this could be one of those game-changing stocks. Now, it took a little while for them to get their earnings and sales, but we're looking for huge earnings, sales, and it's stuff you guys are looking at too, right? It's not rocket science here, but we're looking for those huge earnings and sales, margins, growing category, game-changing product, and obviously a visionary leader really helps too. But the other kind of part that we look at that probably differs from a lot of other growth investors is we're also looking for price performance. We're looking for, is this stock dramatically outperforming the market? Is it just getting a lot of demand in the actual stock market? Are you actually right when you buy it? Are you actually making money? And is it not just going flat or going down at that point? So we're essentially combining the fundamentals from a growth perspective, from huge earnings and sales, but also the technical. So I remember 20 plus years ago when I was learning about technical analysis and fundamental analysis, everyone was kind of just all or none. And it's like, why not take the best of everything, and kind of combine it, which is what Bill did with his strategy. And so it really helps me, at least, narrow down the list of stocks to focus on, first from a fundamental perspective, and then from a technical perspective, is it actually working? Is it moving? Stocks that are in demand behave a certain way. There is a characteristic to them. They just keep crawling up after an earnings report. They may jump on huge earnings and things like that. Those are institutions that are falling over themselves to get more of those shares. And so they seem to not want to go down. Likewise, when stocks are starting to act unhealthy, they behave a certain way too. So there is that behavior, there is that kind of normal, abnormal action that we look for that helps us gauge whether the stock is truly in demand.
Irusha, I'm going to move on in a second here, but I've got to ask you before we finish this segment up. Tesla's at just under $1,200 a share right now. Are you buying shares at Tesla right now, or is this going sideways or down from here? What's your shot? What's your take on Tesla shares right now?
Well, right now we think Tesla's too extended, right? Mm-hmm. Tesla was around, and this is for me personally, what I thought, around like the 700, 800, that's where it's looking appealing. 900, once across 900 in all-time highs. So, okay, something's different here. It's starting to hit new highs again after taking a year off, essentially. You have to respect the market in that, because in the end, and one of the big things, especially that I learned from Bill, is that the market's always right. You can do all this work, but in the end, the market's always right, and so you have to go with the market. So you don't, if you think Tesla's overvalued or it doesn't appeal to your strategy, that's fine. But at the same time, you really shouldn't go and short Tesla, because the market's clearly saying that it's in demand and it's going up, and there's a lot of risk if you're going to try to short something that's in true demand at that point. But Simon, what I could do is, just to illustrate it, I could just share my screen quickly, and we'll sure. talk through this. But here's do you see my screen right here?
Absolutely. Yep. Go ahead. We got you on video.
Okay. So here's Tesla. This is a MarketSmith chart. I have it on the weekly chart right here. And so the first thing that you can see is just this monster run. This is not normal people pushing this stock up. This is not you and I buying our shares at this point. These are larger funds getting into the stock. This is the market cap is over $1 trillion now. So over on the right-hand side here, we have a number of quarters of fund ownership. And so in December of 2019, there are 1,100, essentially 1,200 funds in the stock. Now you go out to September of 21, 2,900 funds. So there are more and more funds. So this has become, in many ways, the must-own institutional stock, right? So a lot of times, really the whole strategy that we look for is we're trying to figure out, what are the institutions looking for? What are they going to be really wanting? Because in the end, 70% of the movements in stocks are because of these larger institutions. It's the Fidelities and these monster kind of funds with all this money that are buying some of these stocks. Now, the reality is they're not going to be buying when the stock is at, they're not going to be buying Tesla when the stock's at $1,200. They're buying it when it was at $600, when it was kind of basing and going sideways and taking a year off. They're the ones who are slowly buying the stock after kind of those first few months in the year where it was starting to sell off at 600, and people getting out of it, and who knows, no one knew at that point what was going to happen. But all of a sudden, there was kind of a floor around 600, and then there were just more and more funds just slowly scooping up shares of Tesla. Tesla was also pretty attractive because it's just, there's a lot of liquidity in it. You can move in and out of it. For these funds, it's huge because they don't have to move. They're not going to move the stock that much. But a couple of big things here are, first, Tesla had this monster run going. You know, obviously, Cathie Wood got very, very famous with her amazing call on Tesla. But you had this strong, super strong run right here, and Tesla was, along with Zoom, the stock of 2020, where it just defied all odds. But there was so much demand, and in many ways, you know, Tesla was more the institutional kind of darling than a Zoom, because you're seeing Zoom kind of fall apart right now. But then it spends 2021 taking a break. But the fact that once the last few weeks, once it started getting back above these new highs around past 900, that's when it was like, this, who knows, this could go on another run. We just don't know at this point. But that being said, you have to just kind of, if you get your position, you kind of have to let it ride. Now, if you're up a lot, take a little bit off. You know, that's never a bad idea to kind of take a little bit off if you're getting a little nervous. But we don't know how far this can go. Just like we didn't know when Tesla started to, in 2019, started to really run at that point, we didn't know how far it was going to go at that point too. We just knew that it was in demand, that there was more of a character change. And I'll actually switch to a monthly chart right here. You can see this is the 2013, 2014 run. So from 2013 to 2014, Tesla went up from, this is split adjusted right now, but from $6 up to $40 or $50, right? Had that first monster run with the Model S. It took 6-7 years for them to really prove to Wall Street again that they're going to pull off the Model 3, then we're going to go bankrupt, all that kind of stuff. All that stuff kind of indecisive, which is why it went sideways. It tried to go for a few times. But once they started proving to Wall Street again that they went through the Model 3 run, and now all of a sudden their TAM, their addressable market is starting to expand, that's when you just started convincing more and more funds that they have to get into this. And then I think the other kind of final thing here, just from a larger conceptual level, is, you know, Tesla has, it's almost a cultish type of stock too. You have that fan base, much like you have the really hardcore fan base of Apple too. There is that loyalty there. There's that product or service that does such a good job that it creates customers for life. So that's another kind of interesting thing, just that I like to keep in mind sometimes. Is it really getting that kind of customer loyalty, customer just almost fanaticism going on there? You know, kind of like I'm a fanatic of the Raiders, and you're a fanatic of the Saints there, Simon.
That is true, and that is accurate. I am a Saints fanatic. That's very true. Irusha, I love having you on the podcast, because this is eye-opening. This is something, like you said, we don't spend as much time looking at. Would you mind if I pull the video back off here for you?
Yeah.
Okay, yeah, perfect.
I thought you were just going to kick me off of the podcast. Hey,
yeah.
See you later.
You're still here, going strong. But I mean, like, Irusha, you have worked in the retail investing sector. You've worked on the buy side sector. You've worked on the sell side. You've seen a whole bunch of different things. I want to kind of double click on a couple of things you said in that last segment, mostly kind of the behavioral aspect of institutional investors. It seems like when Tesla is an example of this, you have a company that really shows it's credible. It has rapidly growing revenues. It has rapidly growing earnings. It almost feels like institutions that are holding billions of dollars of money. Like you said, Tesla goes from, what was it, within 18 months or something like that, 3 times as many institutions were buying. Now it's a must have in funds. It has earned its credibility. It's earned its keep. And it seems like behaviorally, no one wants to bet against Tesla. You're going to burn the shorts, and then Elon's going to mail you a package of shorts to your doorstep. You know, but I want to ask you on the other side of that too. Can you talk about 2 other things too? I'd like to know how institutions think about short interest in a stock, and then also how you kind of generally institutional investors think about valuation.
Yeah. You know, it's kind of hard for me to speak from the institutional perspective. Yeah. So, because you know, institutions and they're people just like us, right? You know, we always kind of think that they're they're all just going to be pure fundamentals. They're going to hold for the longer story. They probably modeled Tesla out years ago, and some have. There are always going to be some. Kathy Wood's a perfect example of that. But there are a lot that haven't, and there are a lot who still doubt it, and there are plenty who are shorting it too. So everyone has their thesis for the institutional. From that perspective, and that's what makes a market, right? There's going to be always disagreement. That's what you're going to always have buyers and sellers. But with the institutions, our whole strategy, and so I'll get back kind of the core concept of why we do things the way we do them. Our whole strategy is to try to figure out what's going to be appealing to the institutions. And mainly the growth fund. So it does not. Warren Buffett is not going to be going to Tesla anytime soon, right? I mean, it took Warren Buffett got into Apple, 5 years ago maybe, and made it. Apple was appealing to us 15 years ago, right? So, and I think one way to look at this is we're looking for those next great companies that are great growth stocks that are eventually going to turn into great value stocks, right? So Apple, I think, is, and not Apple's a turnaround too, but. So that kind of thing. But the reason with the institutions, so with the huge earnings, huge sales, because how many stocks or companies are doing that, right? Not many. And so that increased the odds that more institutions will focus on those companies. Now, once they start having that demand and start going up, kind of like a Tesla, that's showing us that there are more institutions buying it. But the institutions aren't necessarily buying. They're not buying at the $1,200 level. They're the ones creating that base. So we're looking for those rest periods. We call them patterns. We call them bases. The reason why we like those rest periods, those patterns, is because they potentially reflect. It's not always the case, but they're reflecting institutional accumulation. Once these stocks go up, and it doesn't matter, Apple, one of the greatest companies as we know ever out there, its stock would go on these monster runs, and then they would take a long time off. It doesn't matter how great these stocks are, they're going to take some time off. They're going to come to a point where they get to a price on a valuation basis, because institutions obviously are going to be much more interested in the valuations than I'm personally going to be. But it's going to come down to a point where it's going to be appealing to them, and so they're going to start buying it, and there are going to be some other institutions that are going to start buying it. And they're going to stop the stocks from going down. And eventually the stocks will go sideways and they'll start coming up. Now, Simon, I'm going to throw out this phrase to you that maybe a lot of your listeners might not know. You might have forgotten because it's been a long time, but there used to be this thing called corrections in the market. We haven't had corrections in a decade, it seems like, right?
I thought the phrase you were going to say was touchdown Texans, that we've all forgotten about because it's been so long. But okay,
well,
corrections.
That's harsh, right? That's harsh. The gloves are definitely coming off today. But that's great. But yeah, so a lot of times bull markets on average last 3.5 years, and then they will correct for 9 months. That's, without the Fed coming in and doing all the stuff that they've had to do over the years. But these corrections, a lot of times they would come and present great buying opportunities for a lot of these great growth stocks that got away from institutions, come down at more reasonable valuations. So when they were buying, and it wasn't just one fund, but it was a number of funds, when they were buying, they would form these patterns. And so the way that it all kind of started out was Bill O'Neill, when he was a young stockbroker in the 50s, he went back and studied the previous 50 years, 1900 and 1950s, and said, okay, let me study all the great stocks of that time, the railroads and the radio companies and the airlines and all this stuff, and said, okay, what do they have in common? So really the whole framework is these 7 traits that these stocks have in common, which I went over a number of them right now. But one of the big things where he noticed that there are a number of these patterns. And now with technical analysis, and you mentioned I am a CMT, there's tons of great stuff out there. I keep it very, very simple. I just focus a lot of time on the behavior, the price and volume action, because that's going to tell me a lot whether a stock's in demand or not. It's going to give me just a little bit more insight on that. But what Bill noticed is that there were a number of patterns that were forming before these stocks went on these huge runs. So the way, it's not necessarily predictive, right? Because there are plenty of patterns that form. Like for instance, the most famous one that he made most famous is cup with handle, right? So a lot of these stocks had these cup with handles. Apple had the cup with handle in 2004. It had a couple of handles and a number of these other bases throughout its monster run. But just because a stock forms a couple of handle does not necessarily mean it's going to go up 3 times. It's going to go up 3 times because of those great fundamentals. But the reason why I like these patterns, not only because it'll give me an insight when I'm looking at a lot of stocks, I can look at charts first because charts are going to communicate very quickly whether a stock's in healthy or not. Much like a doctor is looking at your metrics and saying, oh, your cholesterol's too high, your blood pressure's too high. Doesn't necessarily mean you're going to die next year, but you're heading towards a path where you're getting a little bit more unhealthy. You might want to slow that down. Same thing with stocks. We can look at these price action saying, okay, the stock's acting healthy or not healthy. And we're using that as to improve our probabilities for success. But with patterns, most importantly, the pattern will help me manage my risk. So it gets back to that initial point when I rode in 2000, the market's down, just rode everything down. That's where I was like, this is the kind of risky thing I'm trying to do here. That risk management really appealed to the point where in 2008, I didn't know what was going on with the whole financial crisis, but I saw in the stock behaviors, in the charts, plenty of warning signs that told me to stay out of the market. And so that's what validated the whole strategy for me, because I avoided that whole 2008 meltdown at that point. No idea. I was out like maybe months before, like almost a year before, and then never told me really to get back in because it just wasn't setting up these things. They weren't going up, these stocks. So I just kind of stayed out, and then it was almost surreal that it got that bad. But we had none of us, and including the readers of IBD, had no idea. We just knew that it's just a little bit more treacherous right now. There are a little bit more clouds. There's a little bit more stuff going on the horizon. Let's just play it safe. We're not going to play as much this time. But so with these patterns, though, that helps us get an idea once you put all the fundamentals together that, hey, you know what? It's not just me that's thinking that this company could change the world, or it's a great company. Just it might not even change the world. Just a great fundamental company. There are a lot of other institutions that, in fact, they might not be telling you, but you can see in their actions that they're slowly buying it because it's starting to form some of these patterns. And when they emerge, kind of like Tesla, when they emerge out of these rest periods, we expect them to do something kind of like what Tesla's doing. Maybe not as powerful. I didn't think it was going to be this powerful immediately, but we expect them to go up from that point. If they don't and they start selling off, say Tesla went up past 900 and now all of a sudden it starts selling off dramatically past 700, I'd be out. I was like, what I would be telling myself is, I love the story, stuff like that. I don't know what's up. Maybe it's me, maybe it's Tesla, maybe it's the market. Something's off. I'm not going to play as much at this point. I'll manage my risk.
Irusha, there's a lot of risk and concerns from people out there about inflation right now. We're seeing the S&P hit new highs. A lot of people are talking about inflation, interest rates right now. Is that on your radar at all? Do you worry about that in any way?
I worry about it from I worry about it. It doesn't really factor into.
Let me rephrase. I apologize.
Yeah.
Let me rephrase my question. Is this on the radar of institutional investors right now? Are they concerned about inflation and interest rates going up?
I think everyone, that's definitely on everyone's mind. I think the simple answer it is because of. I think everyone's kind of expecting that next year is going to be a lot tougher, right? If the Fed takes away the punch bowl and if inflation forces their hand to take away the punch bowl, it's going to be a lot tougher markets, right? We may have a correction. People might get a little surprised there that stocks actually go down. Everyone's been trained that stocks go up and buying the dips all the time, which is fine. It's great, but I'll say this one thing, Simon. I have no idea what's going to happen next year and stuff. But if we ever get those corrections ever again, and if we ever get a bear market, heaven forbid, I do worry about a lot of the investors who've been trading around for the last 10 years and been doing very well and well done for sure. But there is a point where you get conditioned so much, and if there is an extreme market, kind of like, and I'm not saying it's going to be like 2000, but kind of like 2000. I remember in 99, everyone thought the market was easy, me included, and then 2000 just wrote it back down, and I lost even more money than I made in the at the top, right? So, and it wiped out, at that point, it wiped out a generation of investors. So history could repeat on that end, and so I mean that's kind of the bigger thing. But in the end, I think it just depends on your strategy, though. You know, if you're a longer term investor, if you're spreading out more, yeah, I think you have risk management already built in place. So I think one big thing that we didn't even talk about is, you know, figuring out your trading style, your personality. Find a strategy that fits to you, right? Because one thing I've learned over the years, especially from all different types, not just institutional investors, but I've spoken to many more retail investors over the years and many different types. You just got to figure out something that works for you. You know, what you're talking about as seven investing, what your team who's excellent is talking about all the time, those are time-tested values too, right? But you just got to figure out, if you're really going to hold for some of these stocks for the long term, not to have as big a position, right? You know, you got to have spread out a little bit more. I don't know how many positions to have, 15, 20 positions, maybe more. That depends on your personality. For us, one big thing that I didn't touch on is one way that we really handle this, and reason why Bill O'Neill became a very, very successful investor for 50 plus years. He would concentrate in positions. So he wasn't having, when he bet on like one of his huge winners was Syntex back in the 60s. They made the pill. He didn't have a 5% position or 10% position in that stock when it got going. He eventually, he probably started out with a 15, 20% position and eventually built it up to 50, 80, 100% position. Because he really understood the story. He used the charts as risk management, and he eventually built up a profit cushion. So he might have made like 500% on the position or something, but when you have your whole account into it, you know, you can put a lot of points. Now, that being said, there was just still a handful of stocks that he was able to do that over the years, maybe 10, 12 or something like that. But the reason why we value risk management so much is because we're gonna ideally get into positions that are 15%, 20%, 30, even sometimes more. We don't go that much more. I don't go that much more, as much, but maybe a 30% position, right? Even a Tesla, as great as Tesla it's gonna come down 35% at some point. If I have a 30% position, that's gonna really leave a mark on my portfolio, right? So, or if I'm wrong and all of a sudden Tesla is really, you know, getting in trouble like they almost got in with the Model 3, you could have a 30% loss on your portfolio if it gets really bad, right? So that's one reason why we value charts and risk management so much, is because when things are moving in our favor, we'll definitely push more chips on the line. And so we're not always gonna ride through the ups and downs of the stocks. We're looking for something very, very specific and very specific behavior, and then we're there. And if it's not there, we're going to kind of back away. One analogy that I'll use, and we've used this at our seminars and stuff like that, Laird Hamilton, one of the greatest surfers ever, he was on Charlie Rose. You guys can YouTube this on, go to YouTube and listen to this. But he talks about preparing for the next great wave, the epic wave, the perfect wave, and how every day he prepares. He travels to the places around the globe where the probabilities are. And he's mentally preparing and waiting and preparing. And he may go months and months before getting one of those, but he's always kind of preparing. And if those waves aren't there, he's not going to play with them, right? He's not going to surf them. But once they're there, he has to be, you know, ready. And when we heard that, this was like 10 plus years ago when we saw that, that's exactly how we're investing here. We're looking for kind of everything to line up, the stocks to line up with their great fundamentals and game-changing potential, the market to line up, and then, you know, finally being there. And we could still be right. And if we buy those stocks and we think it's ready to go, and if it doesn't go, we'll back away at that point. So that's kind of the way we approach it. And it's saved us from a lot of these once upon a time corrections that were there. but yeah, I mean, the way that people describe Bill O'Neill and the way I look at it and the way I look at myself now is it's more a survivor of the markets. And so my first 10 years, as opposed to a lot of people who start off right now, the first 10 years here have been amazing, right? These have been great trending markets, some of the greatest markets we've ever seen. My first 10 years, I had to go through the 2000 bear market, 2008, the flash crash. So it's funny, like how those first 10 years can have. So I definitely respect risk maybe too much sometimes. Sometimes I won't give them as much time, versus some others they're much more willing to let them ride, because that's what, the last 10 years. But the markets will always change. I hope they continue like this, though. For the record, I think it'd be great. Did I even answer any of your questions, Simon?
It did.
I mean,
it's given me one final one that I want to ask, Irusha. I got one more open-ended question for you, and that is where are the perfect waves right now? Where are the setups and the patterns you think are really, really attractive, either in companies or even sectors right now? And then also, if you don't want to answer that side of it, let's take the other side of it. Where's the danger zones you would absolutely stay away from right now?
Yeah. Now, a lot of things have been running, so it's kind of hard to say where are perfect setups right now. But I'll get it from kind of a larger disruptive level. And these are, for your listeners and definitely your subscribers, they're not a surprise. The cool thing is that we're all kind of looking at the same framework. And so we're kind of fishing from the same pond. We're just going to be in at different times, and things like that. But all the stuff that's going on in fintech, right? With just the artificial intelligence making, and I do own these shares, by looking Upstart, right? Where Upstart's using artificial intelligence to work with banks to enable more loans to people who weren't necessarily credit worthy versus a FICO. So if you want to know one stock I probably wouldn't be necessarily optimistic about or be a little bit more concerned about, it's FICO, right? It's Fair Isaac, where they might be being disrupted right now. They've been around for 30, 40 years. They may be being disrupted by some of these newer companies like an Upstart. But yeah, so you have obviously that going on. You have the buy now, pay later within a firm. There's a lot of disruption going on with the technology in fintech, just globally, where it's making, there's some things, we're very lucky here in the US where things just work seamlessly here, but it's not necessarily the case abroad. So there's a lot that's going on there. So those are some of the things. Obviously, and I'm not huge on this, but I have some crypto. But there obviously that's a amazing trend. One stock that I do own is Coinbase. One parallel, and I'm just jinxing it now because we know it's just going to go down to zero. But the way, because I'll sometimes look for some kind of parallels. It's like, okay, here's Coinbase. They're putting up some monster earnings, monster sales. Maybe there's a parallel between Coinbase, which has kind of built this brand name for retail people who want to get into crypto. Maybe it's similar to what Schwab was going through with the discount brokerage back in the mid 90s and stuff like that. So things like that. You're having crypto obviously influence more and more things. Blockchain is being integrated everywhere. But so those are some of the things. Gosh, in the metaverse. I mean, we even had Facebook change their name to that. But there's so many companies there. Obviously, like a Roblox is an interesting one. I have a little bit of shares of those. One company that I do like is that I find interesting is Unity software, which I own. The reason why I like Unity is there are only two players in the market for gaming, right? For development. If you want to develop software these days, there's only really two players. You go to either Unity software or your Unreal Engine, right? And Unity, I can't remember the stat right now, but I think it's like 70% of the mobile games are using Unities, and now Unity's expanding to other verticals like automotive and some of the scenes from like The Lion King were using like I think the leaves and trees are using Unity, and then obviously AR and VR Unity is natural for that, and obviously the metaverse, right? So those are some of these things. I think one of the big things, and I see it with you guys also at Summit Investing, it's just that passion. I see the passion with you guys. This stuff is cool. When you look at fun, new growth companies and you see, whoa, look at all these amazing things that they're doing. It's really, I get excited by that. You know, I get excited about learning about these companies. And then it's even more fun when you can get profit off of some of these companies too. But those are some of the kind of those trends. I'm always looking kind of for those larger kind of like futuristic type of trends, but that you can get something basic as, look, the EVs are growing big, so naturally the lithium players are big too. So that's a sector that's in demand, that's been doing really well, and naturally just because that's going to be a commodity that all the batteries are going to need. So those are a few of them. I'm sure I missed a ton of them, but there are plenty of things ripe for disruption. That's for sure.
Yeah, I love the list, Arusha. For those who were following along, he mentioned fintech and AI was one trend he was looking at. Upstart, the ticker on that is UPST. He also mentioned cryptocurrencies and Coinbase. Coin's ticker is COIN. And he mentioned the metaverse. Unity Software's ticker is U. Once again, Irusha Peiris is portfolio manager at O'Neill Global Advisors. Arusha, I always have a lot of fun chatting with you. Thanks for being with me on the 7 Investing podcast this afternoon.
Hey, it was great to be on, Simon, and thanks so much. And let's do it again soon.
Absolutely. And thanks again for everybody for tuning in to this edition of our 7 Investing podcast. We are here to empower you to invest in your future. We are 7 Investing.